All right, let's talk about Robinhood. They just released their Q3 2025 earnings, and honestly, it's been sending shockwaves through the market. So today, we're going to dig in and figure out what's really going on behind these headline-grabbing numbers.
And yeah, this is the number that has everyone talking. A 271% surge in net profit year over year. Now look, whenever you see a number this huge in a financial report, your first instinct should be to get a little suspicious and start asking questions.
So let's peel back the layers here. When the numbers look this good, you just have to wonder, right? Are we seeing the whole story or just the highlight reel that the company wants us to see? Okay, first up, let's look at the official story, the one built around that shocking 271% profit growth. On the surface, this looks like an absolute home run. And bam, right away, we hit our first major clue that something's a little off. Their revenue growth was 100%. I mean, doubling your revenue is fantastic, but their profit grew by 271%. How does your profit grow nearly 3 times faster than your sales? That kind of disconnect? Well, it's a huge signal that we need to dig deeper. So this brings us to the most important question of all. Where did all that extra profit actually come from? If it didn't come from the core business, more customers or more trades, then what's the source? And here it is, the secret ingredient. It's an accounting move called a regulatory accrual reversal. Now that sounds complicated, but the idea is actually super simple. Think of it this way. Imagine you put aside $100 because you're pretty sure you're going to get a fine. But then you find out you're off the hook, no fine. So you get to add that $100 right back into your budget. That's what Robinhood did, just with a massive amount of money they'd reserved for a potential regulatory issue. It's a one-time paper gain, and it has nothing to do with how the business is actually performing day to day. So why do it? Well, it's all about the Wall Street game. This little piece of financial engineering let Robinhood absolutely crush analyst expectations. It makes the headlines look amazing. But it's not because the business suddenly became more profitable. It was really just a clever accounting entry. But hold on. Just when you think we've cracked the case on the profit trick, the report throws a major curveball at us. And this is where the story gets really, really interesting. Okay, now check this out. On the left, we've got that net income, the $1.28 billion we've been picking apart. But on the right, that's the operating cash flow. That's the actual, real cash the business is generating. And look at it, it's more than double the profit. This is the central paradox. The reported profit might be low quality, but the company is absolutely swimming in cash. So now we've got a whole new mystery on our hands. If the profit figure is, let's say, enhanced, then where on earth is all of this very real cash coming from? It has to be generated somewhere, right? And it turns out, the answer is sitting right there in the cash flow statement. It shows us the true engine of Robinhood's business. And frankly, it's way more impressive than any accounting trick. This table just lays it all out for us. You can see exactly where the money's coming from, and it is not from that reported profit. Look at the top 2 lines. They brought in a staggering $8.2 billion just from securities lending, and another $3.75 billion from us, from users putting more cash into their accounts. This is the real story. Robinhood's core brokerage business is growing like crazy. So, let's be crystal clear here. The cash flow is 100% real and it's incredibly healthy. It proves that the underlying brokerage business is expanding and firing on all cylinders. But, and this is the most important part, it has almost nothing to do with that flashy headline profit number. These are 2 completely different stories. Okay, so let's bring this all home and talk about what this means for investors and the stock price. Because this is where all this financial wizardry can create a pretty big trap. Right now, Robinhood stock trades at a price-to-earnings ratio of about 70. Now, to give you some perspective, look at its peers. Schwab is around 20, Interactive Brokers is at 36. So Robinhood is already valued at double its competitors. And you have to remember, that 70x ratio is based on the inflated profit number we just uncovered. So what happens when you strip out that one-time accounting gain? Well, the real PE ratio, the one based on the actual core business, is likely well over 80. And a valuation that high, well, it means the market is pricing in absolute perfection. There is literally no room for error. Which leaves us here with the final big picture question. On one hand, you have a genuinely strong cash-gushing business. On the other, it's being presented using some financial sleight of hand. So for an investor, what do you make of this? Is it a fantastic company cleverly playing the Wall Street game? Or is it a dangerous valuation trap just waiting to snap shot? That, right there, is the billion-dollar question.